everybody. Welcome there. It's Joe with you here on a trading room. I'm joined by nobody. I'll be flying solo today. It's good to see everybody on this weekend update. I don't get to do these often, and today turned out to be a pretty interesting end to the week, I should say, Friday. It's for the 13th and the 17th. That's obviously for next week, but let's talk about the 900-pound gorilla in the room. That was Friday's event, and it wasn't just this bank that fell apart down here, the SVB. I mean, this is Silicon Valley Bank, one of the biggest in California. Powell was already talking about higher rates for a longer term. He's been addressing the Senate and Congress for a while, and he's determined to get ahead of inflation. And for lack of what the market understands or what they don't understand, and whether you agree with him or not, the markets just don't think that there is inflation. They think it's going to take care of itself and it's going to slow down since the ball's already rolling. And that could be the case. However, Powell came out and said, no, I think it's still there. Then we got a couple of announcements here that you'll see that actually, I'll get to here in a second, that actually kind of correlated with what Powell was saying. The big part of what happened on Friday was the solvency of the SVB bank. And I'm not even sure what happened, folks, but from what I can tell, it was going to miss its quarter. It wasn't going to do very well, but it just had a mass rush of withdrawals and just selling of the stock, and it just created its insolvency. The FDIC eventually stepped in and halted the stock, and it's going to be a mess, and we'll see what happens over the weekend. But there were rumors of it maybe being bought out and all sorts of crazy things. SI is another bank. It's actually a trade that we have that's also filed bankruptcy. So these and the SVB is not a small bank by any means, but some of these smaller banks, if they do run into these mass exodus, you've got this cash burn from customers. A lot of these small banks might not make it. It's a lot different from 2008 situation. However, there's still levels of concern. Now, more importantly, let's take a look at economic reports. We got the ADP non-farm employment change, and that ticked up 242K with an expected 197. Now, it was expected to grow a little bit, but not as much as it did. There's your first argument that inflation is still up, rearing its head. The other one that I think was very interesting was the non-farm employment change. Down here you can see 224K and expected 311. Remember, folks, it was over 500K jobs added last time. So it is a substantial slowdown from the last time, but it is another uptick from what was expected. The unemployment claims is another number that just barely reared its head above 200K. That's kind of a good thing. So we're still getting mixed signals overall is what I can come up with that. So let's get into the market analysis, and this was basically the tale of two completely different weeks. What I thought was interesting about it is we had a Thursday and Friday last week that just shot up. Also, I didn't see it coming. It's also kind of out of nowhere. I shouldn't say that because there were some good signs in the economic numbers that maybe pushed us higher, but something that I truly wasn't expecting. What happens Thursday and Friday of this week? The exact opposite. You guys can see here, I'll get to the chart. We just completely fell apart, and a lot of it had to do with insult to injury. Seeing that we did have a hotter than expected economy, we've got a hawkish Fed, and then this bank situation came out of nowhere, and it just really kind of added to the fire. How did we finish? Brutal. Most of it was Thursday and Friday. Dow, S&P, and the NASDAQ all down over 4%, or about 4% for the NASDAQ. Russell's down 8%. Oil and gold. Gold hung in there a little bit. I imagine that flight to safety. We do have a bond issue, right? The shorter term yield. We got an inverted yield curve, seeing a lot of flight to safety. And finally, I'll show you here in a second, the VIX participated for the first time in a while. Let's get into the charts. You could see that it was a beautiful bear rally pattern that actually kissed the 20-day moving average, and everything just shows signs of bearishness. If you are any sort of technician or technical trader, this is exactly what you want to see. The volume on Friday was outrageous. I think a lot of that had to do with the banking situation. But once again, we were already falling. This usually kind of happens when it comes to bear markets and capitulation situations. It doesn't take just one event. It's got to be 2 or 3 or 4 things that happen all at once. Now I'm going to go ahead and record here, and I'll talk to you in a second. We're not there yet. This could be the beginning of something. Maybe it gets erased this weekend. Maybe we solve this banking problem and the markets come back to Monday very positive and we turn right back up. But it's not over. It's not the capitulation I'm looking for. The 380 level is what I'm looking for more specifically when it comes to targeting on the SPY. Let's move to the Qs. Also, same pattern. Went up, hit a falling moving average. Beautiful shooting star Joji, by the way. I like that on Monday. And then rolls over, and it looks like we're breaking below that 50-day moving average, which could be pretty big for the NASDAQ. Now, this isn't specific to financials. Obviously, the SPY is going to be the weaker one. You saw the charts on KRE. Well, let me show you the charts on KRE while we're here, and SIVB. You can see that these things just got smashed. That's the same with the XLF. We'll see that chart here in a second. But everything financials is going to be the weakest one. Tech is falling, but it did hang in there. And here's the volatility index. That's the spike I'm talking about. We've talked a lot about revisiting some of these areas up in the 30s. I still am looking into October for something as far as capitulation goes, but this was a pretty good start. Intraday, you could see that we were at about 27, and it did close off of its low, but comfortably above that 20, what do you want to call that there, the 23 resistance that we saw in February. So we'll see if that's going to continue to stay where it's at or if it's going to come back down. But that is the first true signal that I've seen in a while of true fear. And once again, it's because 2 or 3 things happened at once. It wasn't just one. So this coming up week's events, I'm just going to say it's 100% what happens with this bank and the investigation. Janet Yellen actually came out and said that they're looking at other situations and other banks that might be in this situation if we see cash burn and a max exodus out of it. So we'll see if hopefully it's not an onion that we keep on peeling, or maybe it's just an isolated event. So that's going to be a number one. The VIX is still too low for a meaningful bottom. I did love that spike, folks, but it's not in the 30 range. That's true capitulation. It looks like it might have started, so we'll keep an eye on the VIX. We do have that CPI report on Tuesday. I truly think that if that might be another straw that breaks the camel's back. Let's take a look at these. So we've got the CPI. We've got core retail sales. I think that might be interesting. I'm always interested to find out what the consumer's up to. And then we have the Philly Fed Manufacturing Index. So Tuesday is going to be a big deal. I should say Tuesday. I thought I said Monday. I apologize. Tuesday, where that CPI number could really change the tone for the rest of the week. I don't know if we just kind of park it on Monday and wait to see what's going on with these banks in anticipation of the CPI. And then Tuesday, the gates open again. We'll see. So it was pretty easy for me to come up with this outlook. -2 on the weekly outlook. Why is that? Well, below both moving averages. We get a sloping 20-day moving average, and a 50-day looks like it's about to pitch or it's flattening. So 1, 2, 3. Yep, I'm -2. And on the monthly outlook, I'm going to go with a -1.5. I want to go -2. Because if we do get capitulation, it might hit that 380 level and park itself right there. So I imagine we're going to slide. I'm very comfortable being bearish, but we do have that 380 support level in the SPY. Let's get to some sector analysis here, guys, and you're probably going to see, oh, tell me something I don't know. Everything's down. The only thing that hung in there was down 3%, and that was utilities. It was interesting to see real estate and the financials. I think they're going to go hand in hand. Materials slipped pretty aggressively. But you can see technology hung in there, 3.79%. So let's go ahead and rank these things. This is XLU. This is utilities. It's absolutely going to stay at a -2. It's in the same situation that the overall markets are. And I think that if we break the 64 support here, I think we slide lower and might easily revisit 62 or even 61. Taking a look at communication services, this has got another beautiful bearish setup. However, I'm not as aggressively bearish on it because take a look at this line here. It's across right at that 52 support level. You can see it hit it a few times through the end of last year. So I imagine it's just going to hang up on that for a little bit. It might slip a little bit below it or above it, but I have to give it a -1 because it's kind of, I don't want to say outperforming. You can see it's been getting sold into pretty consistently since February, but it is above some of those areas. I know, I'm looking for the strongest out of the weakest, right? Here's real estate. Real estate looks like it's about to break. I do think if we roll over that 36, if this is indeed a banking issue that's going to carry forward, we already have higher interest rates and high home prices that are continuing to sell, but mostly with cash offers. That's a bubble that I think hasn't even started to deflate. I'm comfortably at a -2 once it does. XLI, industrial sector, this is like a high base. It seems to be holding in there. Now, Friday's candle was scary, so was Thursday's. It really depends on what it does here at 98. If it can stop, then I'm just going to keep it at a 0. If it can't, well, then I have to slide it over to a -1. However, folks, that being said, I just showed you about 6 charts that I would rather be short in than this one. Let's go to healthcare. Healthcare has been struggling quite a bit, and it seems to just be bleeding off here. It might feel a little bit extended. So if you wanted to play something with the ability to absorb a bounce, like a diagonal spread, that's fine. I'm still -3 on this because I just think it bleeds off down to the 122, 120. Now the -3 comes across as very aggressive, like this might flush out and hit. I just want to stay -3 through April, but I do think it's going to be a slow -3 bleed, if that makes sense. Not a huge wipeout. Speaking of wipeouts, this is one that is flushing out right now. And here's the XLF. I told you I'd show you this chart, and it looks very similar to the other two, right? So it looks like it's going to stop here, but that's after a gap. It's right in the midst of a support level that is set in December. And understand, this is a Spiders ETF, financially heavily weighted, but there's other stuff in there. There's other banks that aren't necessarily on the watch list, or the worry list, I should say. So I really think a lot has to do with what gets done over the weekend with this situation. Maybe we find something worse. Maybe it's not as bad. We'll see. So it's flushed itself out. I'm going to stay at a -3 on this because if it wants to roll over, it'll do it again, and it'll do it very aggressively. So there's our financial. Consumer discretionary. This one's held in there pretty good, but it's bleeding lower. It's got a support here at 135. I'm a -1 on this. This would be more. I'd be more than comfortable doing a diagonal spread on this. I wanted to give it more than a -1, but these seem just to survive in some of these situations. So we'll see what happens. Here is technology, and it is by far the strongest. And it's just because it hasn't broken down. It's been beaten down. It's been the leader of the move in January, and it's distanced itself from banks. Ironically, SVB was one of the biggest lenders for Silicon Valley for those tech startups, right? Yeah, well, I guess they're kind of disconnected, and it is only one bank, but we'll see. It's holding on above that 200-day moving average. I'm comfortable, or excuse me, the 50-day moving average. I'm comfortable leaving it at a 0 for now, but I'll keep an eye on it if it rolls further down. Let's get to materials here. Materials, it looks like it's at its support level at 78, similar to utilities, but I just think there's a little bit more strength in utilities. I'm going to give this a -1 because if 78 doesn't hold, I think it might kind of whipsaw. It might jump down to 76 and bounce back up to 78. So this wouldn't be anything too aggressive. This would be more of a sideways to slightly down, credit spreads, diagonal stuff, things of that nature. Let's get to energy. I got a descending triangle pattern on this. I'm comfortable with the -2 because I just want to see that break that 82 level, and this thing could be off to the races. How aggressive you want to get with it is up to you. So take a look. Makes sense. Everything's 0 to -3. Well, that's because we had a heck of an end to last week. And we'll see where next week takes us. So let's get into some possible trades. We had one really work out for us because it was a bank that actually went belly up on a bearish trade that we had. But let's start with real estate. This is HST. This is the trade that we had from last week. It's on the lower part of the butterfly spread. We had a March 17th, 15, 17, 19. So we got about a week here, and this could easily climb back up to the 17 level. So you can see that we're just right in the lower part of, I should say, the further downside of our profit level. But it's holding in pretty good. It's a pretty good trade. What am I looking for this week? Well, let's look at CCI, Crown Castle. I'm thinking at 125, 130 bear call spread on this credit side, because if this doesn't really want to break down, it's nice to kind of eat up that theta. So you can see here's 130 and here's 125. It's at 126, so it's already kind of in the money. So let's just let that 125 bleed a little bit, and then hopefully it'll leak down there and get below it. This whole thing can close, or close for max gain, right? It'll just expire worthless. But until then, in case it wants to struggle, I just kind of like the credit spread. Communication services. This is another trade that we had. This is Meta. I liked this. 185, 190 bull call spread. Stock's down 1.75%, but it is outperforming. This is actually hanging in there pretty good. Now, this was also for the 17th of March, so we've got the rest of the week to see if this can hang in and maybe turn higher. We're not asking much, folks. We just want this to get back up to that 190 level. But it is very positive to see that it did hang in there. This is one that I thought would just get smashed, but it's got its own problems that it's working through, and so it was a little bit immune to Friday's move. This week I've got Vodafone. It looks like it's in a nice bull pullback, and it's moving a little bit higher here. I'm looking at an April 6th, 10, March 17th, 12 diagonal spread. Not getting too aggressive on this. More of a consolidation play if you take a look at how we have this set up. This is we're buying it a little deeper in the money. We're selling 12, not the 1250. We're just selling this last little level right about here, and we're thinking that okay, in the rest of for the rest of the week, it's just going to maybe float up to 12. We can make a decision at that point if we want to roll it higher, take the whole thing off. But I thought it might be kind of interesting. Communication services, something that's been hanging in there, and if we do see weakness, that's why we don't want to shoot for the moon. We just kind of want to play something sideways, and it's a way to do it. On the healthcare side, let's take a look at our past trade. This is TDOC. This was also this coming week, March 17th, 22, 25, 28, bearish butterfly. So this one slid quite a bit. It is still within our profit window there because we are at the 22, but it might hold on. If it makes it, that's great. I'm pretty sure this will tell us if it's going to work or not by Monday. The trade that I have for this week is going to be Moderna. Moderna looked pretty good on a sideways to bearish trade. It's one of these things where when you have a bear call spread, you're doing the credit very similar to our last trade. Is if it's not going to break down, let's at least take some time. This is March 24th, so it's a couple of weeks out, and just see if it can hang on that 39 where it's at or roll over and fall apart. That's what we're hoping for. So you can see it's consolidating right at the 40. We're not looking to too big of a bite out of this thing. We just need this just to drift a little bit lower than where it's at. Industrials, we've got GE. GE was a trade from last week. We had the 84 March, 88 diagonal. The stock's up 7.6%. And what happens with these is when it works out for you, you got to make a decision. Either you're going to buy back the 88 in this case and sell something else against it, or you just take out where you are in the risk graph and take the whole thing off. And what I mean by that is when you get into a position that just doesn't really work out the way you wanted it to, and this is what I love about the diagonal spread, it doesn't really punish you too bad for going higher, right? Now this is the 88 target, obviously, that we wanted it to get. You can see it blew right through that, and we're up at 91. That means we're probably about in this area. Now, this was taken off because of that. It's just a little bit aggressive. In hindsight, it would have been better to do the 85-90 vertical spread. Okay, hindsight's 20/20. But the way it started out was great, according to what we saw here in this chart. And this gap up, oh, geez, that's great. It would have been better if we had just a straight call or a vertical spread. But I love this type of strategy because you're not punished. We didn't go back down to a loss. We just took a little less of a gain. So that's many parts of the diagonal spread. This you probably already know, but I like to revisit it sometime. So great trade, worked out for us. This week I want to do plug. It's a low base, and it is slipping below that 13 and maybe at that 12. So I'm looking at a 12-13, another bear call spread, trying to take advantage of that theta. This is also for the 17th of March, the rest of this week. And we're not looking for it to do much, but kind of float lower to that 12 area and just bleed off. The low base was actually around that 14 level here, 14, 13, and it's slipped below that, obviously, with the rest of everything on Friday. All right, moving on. Let's get into our financials, and this is the one that was pretty interesting. This is SI. This is a March 17th, which is this week's 5-7 bear call spread. We got ourselves another credit spread on this, and we don't have to do anything about it because they just announced they're going out of business. Now, I just let the whole thing go. It's going to expire for max gain, and that's it, right? So this is one of those banks. We'll see what happens moving forward. Now, one that we could take a look at is Upstart. Thinking of a bear call spread, another sideways to down for the March 24th. Going to go out 2 weeks on this versus just the next week. 14.5, 16. It's a little wider than the last couple, and you can see that we're actually targeting this. Let me zoom in on this. You can see that we're actually targeting it here down at 14. You could actually make the argument of 13 if you guys wanted to open it up a little bit, but I do like the fact that it is rolling over and starting to take that direction. It's got a couple of weeks. I would actually be okay if you guys wanted to do this 1 week out, just taking advantage of the whatever surge we could see the beginning of the week to the downside. I'm fine. That's why these are suggestions. They're just trades for you to kind of follow. But there it is on the financial. I'm sure there's a lot more ugly out there, but that's the one that I saw that we thought would be kind of neat. On the consumer side, we had Walmart. It's got one more week out, and it's pretty darn close to its max gain. It's a 139, 142 bear call spread. And as long as this bad boy stays below the 139 where it looks like it's going to be, we'll just let this go. It does have the rest of this week, so as long as we can stay right below this line here at 140, it should be working out great. This week I want to talk about Rivian Auto. This is a low base, and it's drifting a little bit lower past that 16 level. So I'm thinking 12 and a half, 15. It's a little bit more specific. It's already below that 15 area. But if this continues to bleed, what's great about this is it doesn't hurt you, right? We just need this to kind of stay where it's at. And here's the low base right here at 16. You can make the argument between 16 and 18, and it just barely drifted below it. But it's been below it all week, pretty much, since Tuesday. That's a good sign for a bear trade like that. So if you wanted to open it up, that's fine. Go to 13. You want to do something a little bit more aggressive, that's fine as well. But more sideways might be better for this. Technology, we had our Nvidia trade. This was a 237.5, 245 bull call spread. It's performed pretty decent, but it hasn't really done anything for us. We're okay. We've got the rest of this week. And what I like about the vertical spreads, you don't have to worry too much about that time decay, especially with the debit, because we bought and sold the same time decay. We just need this to truly go vertical in this case. We want this to be at 245. It's hanging in there. It touched the 20-day moving average. I like the way that it came off of that, and this could easily get up to that 245 target very, very quickly. It's a very volatile stock. So we're holding on, and it looks pretty decent. This week I've got STM in a high base. We're thinking about an April 45, March 50 diagonal call spread. You could go a little longer on that, depending on how aggressive you want to be. I'd be okay with just a straight 45 call. I like to see that when these do break, it could hit that 52, 53 very quickly. You can take it off the table. You've got April. It's a long enough time. However, it gets expensive. So selling the 50s, okay. I like that. Now remember that the risk graph that I drew you guys on that last trade, even if it does jump up to 52 or 53, we're still going to be in that profit depending on how much money we can get out of that 50. So it just depends on what one you want to sell against it, or if you can't afford it, just doing the straight 45 with a target of 52 and going on from there. So into materials, we had steel, and this just didn't work out. Hey, you can't win them all. 29.32 diagonal spread, and it broke the $28 support level below that 50-day moving average, and I believe this one was taken off. So, hey, you get stopped out, you get out, you put it into something else. This week, we're taking a look at CF. Possible low base breakdown. You guys can see that. We're just going to go straight 85 puts. Sometimes simplest is best. If this is something you can't afford, we're already down at that 80 target. So you could investigate maybe an 85-75, maybe 85-75 bear call spread. That might be something cool to play sideways. An 85-75 diagonal spread. I just think that it might kind of retest that 85 area. That's why it's kind of nice to have the straight put on this, because if it does continue to fall early next week, we could just simply take profits and move on to something else. Last, we got energy here, guys. We have Schlumberger, right? No, it's Schlumberger. It's a joke here. So Schlumberger is a butterfly, 51, 55, 59, and it's right at the break-even point, but this could come right back up to that 55. So we're just going to let this play out and see where we're at. It slipped a little bit. We'd like to see it right back up to those moving averages, but it's still on the table. It's still got a chance, so we'll see how that plays out. For next week, I'm looking at PBR. Looking at a 950, 11, 1250, another butterfly. These can get tricky, so being tight is fine if you're not too far out. And you can see this is the 17th of March, 95, 950, 11, 1250. It's completely sideways here. If you're worried about it going a little bit wider or breaking out, then you can switch up strike prices. It's all up to you guys. This is what we're shooting for. We're thinking it's going to sit right at that 50-day, just below it, around that that area there, and for the rest of this week. These are difficult sometimes, especially when we're about to get into especially when we're going to see the volatility that I believe we're going to see next week. All right, guys, there's some thoughts, there's some ideas. Keep in mind, it will be driven by what's going on with SVB. I think that's going to definitely be on the forefront of the beginning of the week at least, unless they get it solved over the weekend. I expect bearishness immediately. People late to the party, people trying to get their money out. We're starting to see that in the volatility index. Hey, I appreciate you joining me, and it's fun to do these classes. I don't get to do them all the time. So we'll see you next time. Bye, everybody.